Welcome to another episode of Rich Dad's StockCast, where we help you to navigate the world of investing and financial education. I'm your host, Denney, and today we have a critical topic: the ramifications of the labor market on the economy and stock index levels. Now, before we get started, remember to like, subscribe, and leave your comments below. Your feedback helps us to bring you more of the content you want to hear. And don't forget to visit StockCastBonus.com for free access to valuable educational resources to boost your financial knowledge. Joining us today is Rich Dad expert Andy Tanner. Andy, welcome back to the show.
Del, it is great to be here, launching off the season 3. I can't wait to get started. This topic is a huge one, and I'll talk a little bit more about why I've had my eye on it. But most of all, it's just great to be here, and I just welcome everyone that's both listening and watching.
Absolutely. Now, let's get into it. I want to jump into it. I don't want to belabor it. So how does the labor market impact the overall economy?
That's pretty good. I don't want to belabor the labor market. That's pretty good. I like that. So here's the thing, and maybe I'll just start our discussion this way. If you're an investor at all, or you're thinking about learning about investing, you really care about the Federal Reserve. As the Fed goes and as their interest rates go, they have a huge impact really on the markets. And when the Fed began to raise rates, aggressively to stop inflation, I told my team and they agreed. And I asked my team and told my team both. I've had my eye on the labor market ever since. The Fed, when the Fed has a dual mandate in each hand, they have price stabilization. So on one hand, they're trying to keep prices fairly stable, not meaning that they freeze them, but they don't want them going up too fast. They just want a nice stable increase, about 2% a year. That's what they like. For whatever reason, they think that's healthy. They haven't been able to do that. They've been below it, then trying to get up to it, they've shot past it. But in their other hand, they have employment. The other mandate is to keep full employment, which we're at right now. 4% unemployment, that's considered 96% employment. We'll argue about those numbers and if they're right, who's underemployed and who's quit looking and dropping out. I mean, it's probably higher than that. But the problem is these are often opposing goals. And that's the challenge of the Fed. And their tools of interest rate, quantitative easing, the reserve requirements, they have many, many tools that they can try to tweak that. So if inflation is taken off, and they're trying to slow that down, the labor market can drop. And as soon as the labor market starts to drop, then they've got to switch that again. So the reason we talk about the labor market, and the biggest thing is just to have your eye on it, because that's going to be the thing, number one, that makes the Fed worried. And the other thing is, and this is a long answer to your question, the labor market, when it starts to go south, it can be a domino that can really trigger a lot of problems. If people don't have a job, and there's a lot of people that don't have a job, then people don't spend. And when people don't spend, companies don't make money. When companies don't make money, they cut costs and they lay more people off. And now you have more people that don't spend. And so companies don't make as much money, so they got to cut even further. And it can start a downward spiral that can 1929 you pretty fast. So it is just an opening. That's our discussion. That's what we'll talk about.
Now, given what you said, and also given the recent decline in job openings and slower job growth,
yeah.
Andy, what would you say, what are the potential ramifications for the economy with, declining in jobs, slower job growth? What would you say?
Yeah. So let's get into those numbers. So they haven't moved a lot. They haven't moved in a great direction, but they haven't stayed neutral either. They haven't been blown apart. The first number in terms of jobs available, for a while there, man, you couldn't hire anybody. I mean, it was just so many open jobs. That's kind of stabilized and pulled back just a hair. So it isn't like these numbers have been cut in half. They've just dropped a little bit. And then you see unemployment just edging up. And when you trade stocks, you look at trends. And trends happen in interest rates, and trends happen in all kinds of numbers. And so, you'll see a trend up, and then it'll begin to slow. And so it's like a football, it takes off really, really steep, and then it kind of hits its apex, and then it begins to decline. Well, in my opinion, these numbers have hit the apex, and now they're starting that downward trend. And so when you put in a lower high, that's where you don't get better than the number before, and you pull back a little bit. Now we'll see just how far down we go until we get a floor. So those are the two numbers we're looking at. And in terms of how they affect the economy, it's very much what I said. If people don't think about your household, if a person doesn't have a job, those listening, if your income went away, what would happen to your spending habits? And what happens is we could talk about the financial statement. You have 4 boxes basically: income, expenses, assets, liabilities. And the one box is always the same. It's bills. Money goes out the door. Food doesn't stop. You got to eat. Clothing doesn't stop. You got to have clothing. Shelter doesn't stop. Got to pay rent. Medicine doesn't stop. You got to, take care of your health care. So those 4 things, and, probably your cell phone bill is close to that too. Those things, they're necessities. So one of the boxes never changes. It's just money going out. So the question is, which of the other 3 boxes feed it? Well, the best way is with new money. New bill, new money. I got if you're in the rat race, you get a new bill, you get a new paycheck. You get a new bill, you get a new paycheck. New bills, new money. Best way to do it if you're in the rat race. But if that job goes away, that ability to create new income every month goes away, now you've got to look at how you're going to pay those bills. And it's going to come from one of the 2 other boxes, which is old money you've invested or saved, or borrowed money and both of those have limits. You have a limit on how much you have. And so what people do when they lose a job, ramifications of the economy, when a guy loses a job, now they have to look at the other 2 boxes, and it creates an hourglass and some panic. And they all of a sudden, instead of looking at your life in terms of money, you look at your life in terms of time. How much time do we have before the asset column is drained? And how much time do we have before our liability, our credit limit is reached? And so that's going to change those spending habits, and they're going to work hard to minimize that new bills box and extras. Maybe you have let you say, how does this affect the economy? Well, the first thing to go is things like I would go look at a company like Starbucks and say, nope, can't go to Starbucks, got to have my MJB. Or, you've got all these subscription services like Hulu and Peacock and who knows what. All of the internet subscription services that people have, they start saying, maybe that's not the one I want. Maybe that's the one it is. And they really have to decide which ones are going to benefit them financially. Am I going to keep my Wall Street Journal or my Sports Illustrated? It's probably Wall Street Journal at that point, right? So as they tighten, if you picture millions and millions of people tightening like this, companies are going to make less money. And when companies make less money, they have to cut costs. And with AI coming on the scene, that could accelerate for a lot of people. Let's go hire a company to help us replace our folks with AI. So unemployment could be rough. Hopefully AI can help the corporations keep going. But boy, if I worked for someone right now and I had a job, I'd be nervous. Nothing is guaranteed.
Yeah, nothing is guaranteed. It's kind of scary as we look at what's around the corner, whether AI is going to be positive or not. I think it's going to be great,
Yeah.
right?
I think it'll
But
be a mix. It'll be good for some people, bad for others. It'll be a mix.
Yeah, I think so too. Just with any great invention, whether it was the car or the radio, there was all these worries about pros and cons of each. But
Oh yeah.
I think it'll be great. But what about when it comes to the labor market situation? More on a macro scale, how does it affect the stock market and the index levels?
So that's a big one. So we have the impact on the economy, and the stock market can be a leading indicator. It can be a lagging thing. It can lead and get a little hot, anticipating good times ahead. It can fall behind and really react ahead of time, or it can lag behind. When numbers, if economic numbers come out and they're really rough, it can react to those after the fact. So it can be a very forward-thinking instrument, and it can be a very reactive instrument. The challenge is earnings. One of the things that is concerning for me and my team as we talk is there's been a consolidation of wealth with just a handful of companies. I mean, Nvidia with the AI boom, Nvidia has just been. I mean, it's going to be bigger than Apple. I mean, it's really taken over one of the top spots. So you have these handful of companies like Google and Nvidia and Amazon, these kind of like a new version of the FANG trade. We'll have to come up with a new name with throw Nvidia in there. Netflix, maybe it's the FANG trade too, Nvidia and Netflix. But the fact of the matter is, a lot of these other companies are getting closer to their 50-day or below their 50-day moving average, meaning that there's already sort of a divergence that the overall market and the index is struggling anyway if you pull out just the best. So that means if you're a non-diversified investor, if you're not picking those winners and riding them, you're losing money right now. If you're a diversified investor, you're in trouble because you have systemic risk. We'll talk more about that. But as it's a weird market in that the resiliency of Nvidia, the resiliency of the big ones, and that consolidation of wealth, it's really masking and hiding, in my opinion, some pretty rough water that's already starting to happen underneath. And even those guys are not going to be invulnerable when the tide goes out. So yeah, those indexes get affected when companies don't earn money. They're going to report lower earnings. They're going to report, they can pull back on dividends, which is really the beautiful thing about what we teach, because the way we teach this is there's, the options market is always available for cash flow. And I really don't concern myself too much with what level the stock is at. I mean, you don't want something at $1, obviously, but there's always a resource, no matter whatever if the market levels were to return to where they were, say, 10 years ago. I was trading options at that level just fine. I can trade options at that level again just fine. So there's a sense of security that lets us detach from the index and allows us to have a resource of income that is independent, because there's always an options market. There's always liquidity in that market. And what's really cool is if you know how to trade it, when indexes fall and the fear gauge goes up, those options can get really juicy. Even though the prices are lower, the strikes are lower, which means lower premiums, the volatility takes them up. So there's a huge opportunity. If someone's listening and they're saying, man, I wish I had a business or a skill that was more resilient, in recession, depression, learn to trade options, man, because that market's going to be there in good times and in bad times. That's a great skill to have, is to learn how to sell options.
Yeah, very much so.
And to buy them for protection, I might add.
You mentioned Nvidia just a second ago. Amazing rise that it's had. As we think about this economy, is there any other specific sectors or stocks that investors should really be paying attention to?
Well, Nvidia's been strong in keeping the tech sector high, but I'll tell you, in troubled times, tech is volatile, and so they should keep their eye on it to hedge it, or to maybe shift some allocation of assets. It's a tough one because AI provides opportunity upside. What would be glorious, and what I would watch for, it's only one scenario that's possible, but it would be absolutely amazing if we could have a huge pullback. I don't want to root for people to have unemployment. That's not the point. But as an investor, like COVID was a horrible thing socially. It was an insane opportunity financially. And the nature of the market is that it fluctuates and that we have crashes. And if you go back to even 2000, where we had the dot-com bust, and you look at those low levels, and you just think, man, if I'd invested heavily in the middle of that crisis, I'd have done well. And then if you look at 2007 and 8 and 9 in the subprime meltdown, and if you'd have gone at those levels, boy, you'd done well. And if you look at COVID and that crash, and you get into those levels, you've done well. So every time there is a catastrophe, guys like Warren Buffett pounce. I mean, we're just thrilled at the idea of everything is on sale. It's like, instead of Black Friday, it's Black Swan, but it's time to buy. It is time to buy, and that's it. So maybe we can talk more about that. We'll probably do for a break. I don't know. I get going, and I don't keep track of the time. I'll let you do that.
Well, let's come back to that. Let's take a quick break.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning, as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to this episode of Rich Dad StockCast. Again, our topic is the ramifications of the labor market on the economy and stock index levels. Now, before we get back to Andy, remember to like, subscribe, and leave your comments below. Your feedback helps us to bring you more of the content that you want to hear. And don't forget to visit StockCastBonus.com for free access to valuable educational resources to boost your financial knowledge. All right, so let's get back to our topic. Andy, now, the question that I want to ask next is this: how might the Federal Reserve's actions be influenced by the current labor market trends?
Yeah, so this is huge, and my friend Robert Kiyosaki has really been predicting, some tumultuous times in a big way, and he's been doing it for a long time. And I have to agree with the data that he sees in making those predictions. What's really disconcerting is someone might say, well, Robert's just kind of a perma bear. He's always, rah, rah, bear. And because he likes real estate so much, he kind of enjoys watching people in stocks. If they do poorly, he gets to say, well, see, I told you so. But the reality is, Kenny McElroy is getting out of real estate, right? I mean, the guy that Robert invests and Kim invests heavily with, he's not, I shouldn't say he's getting out of real estate. No, excuse me, strike that. What he's doing is he's not doing anything new, right? He's not looking to, like, construction loans and the cost of building things with inflation right now and the cost of borrowing money. It just puts you in a rough spot to start at these levels. So it isn't like that's vulnerable either. But as far as, what Robert's saying about a crash, my team is more concerned now than we have ever been that we think that day might be getting closer. And what's disconcerting is Warren Buffett is joining that discussion. If you listen to what he said, he's like the ultimate optimist. Buy stocks, buy stocks, buy stocks. And he said this. He says, I don't know if it's tomorrow. I don't know if it's the next day. I don't know if it's even the next year, but there's a big one coming now. There's a big one coming. And every day the person is uneducated, they know they've just gotten a day closer to whatever that is, less prepared. So with that kind of long preamble to your question, how does this affect the Fed? And that's why I think this is so dangerous right now, is I think the Fed, if you ever see a car wreck that's kind of swerving and then it overcorrects and then it overcorrects and then all of a sudden it just swerves one more time and starts to roll. That's what I kind of feel like the Fed has done. And it's really, to me, looks like a car that's just trying to correct and losing more and more control as it does so. If the labor market starts to suffer, that puts the Fed in a very difficult situation, because they have inflation at the same time. And so let's say you try to correct the labor market. Well, they can't even afford the grocery store anyway. And if you can't afford the grocery store, that's a tough place to be, right? And so they can't, I mean, there's people that are cutting back on a lot of things. That's why we see so many companies below that 50-day. We see a lot of things going down below. Earnings has been a mixed bag. It hasn't been like everybody's earning money. There's been some doing well, some are not doing as well. So if the labor market begins to suffer and the mandate of the Fed, they've got to go back to some type of interest rates. And I'll tell you this, a quarter point's not going to mean anything. A quarter point's not going to turn anything. It's not like they're going to be able to say, oh, let's drop it a quarter point. Now all of a sudden people buy houses again. That's not going to do it. It's just not. They would have to make a major drop in that. Well, then inflation resumes. And the whole thing they were trying to prevent in the first place. So this idea of arriving at inflation, trying to avoid a hyperinflation, which is really far down the road, but those things happen quickly. And the idea, so visiting that extreme inflation is something they want to avoid, and they want to nip it in the bud as soon as they can. But avoiding a depression situation, the history of 1929, it's like Alan Greenspan, Ben Bernanke, Janet Yellen, and Jerome Powell. Those guys have just said, we're not doing that again. And so it seems to be that they have a preference for inflation over deflation. The COVID inflation, they tried to label it as transitory. It's now sticky. And sticky inflation is sticky. Look at the rates we're at. And it's still not really, it's curbing it, but we're still above 2% inflation. We're still above the target. And the prices aren't going to go back down to where they used to be. It's called disinflation. It's not deflation, it's disinflation. It's different. It's the rate of inflation. Instead of going like this, it starts to level off, but it's still going up. So if the labor market starts to show some rough numbers and those numbers become significant in a short amount of time, what does the Fed do? If you can't just do a quarter point to save that, you got to go aggressive and you just resume inflation and start building it right back up. So it's like these weights are getting heavier in each hand and hard. Instead of 5-pound dumbbells, they've got 100-pound dumbbells where it's very difficult to manage this balance between labor and inflation. And right now they're being aggressive with inflation. It puts the Fed in a heck of a mess. I wouldn't want that job, trying to steer that car. Other problem the Fed has is they'll turn the wheel. They got to wait 2 quarters to see where the car went, whether it corrected or not. And so they've got this impossible job. And that's why I think trouble, along with 1,000 other topics we could talk about, like the amount of debt we're carrying right now and the amount of leverage in the markets, I've just seen this movie before, Del. I've seen this happen now. I'm old enough where I've seen where when there's this amount of leverage out there and all of a sudden there's a pullback, people get exposed. It's a tough thing and doesn't change. Human nature doesn't change. It's going to be rough out there. So that's a long-winded answer to a very simple question. What happens to the Fed when the labor market drops? They might be forced to enact policies that would resume inflation and overcorrect once again. It's a rough place for them to be to find a balance.
It really is. And as you're saying that, it reminded me a lot of, history repeats itself. It makes me think of 2008 and everything that happens there. Now, as I think back, luckily I made some good decisions back then. I learned from you, everything went on sale, so I knew what to do.
Yeah.
But moving forward, as you look at this economy, and maybe people didn't go through 2008, or maybe they did. As we approach this new, I don't want to say new economy, maybe we call it a new economy. What strategies should we be using? What strategies should we be implementing as we go through this?
Yeah, knowledge is the only thing that can save you. I mean, it is so funny how people are. And I get it. I mean, I've been a financial educator for 30 years, so I kind of get it. It is a lot like being an asset protection attorney. Is the problem with an asset protection attorney is they're doing their best to sit down with their client and speak wisdom to them early. and to have the client really take it to heart. They'll say, look, you should set up your partnerships or your LLCs or your business entity now, because when the lawsuit comes, you can't change it, right? Do it right now. Same with tax. Someone says, set up your tax structures and set up your tax plan now, because a year from now is not the time to do tax planning. It's time to pay the tax. So it is human nature to procrastinate. It's human nature to put off to tomorrow, what they don't feel they need to do today, and it's to their own peril. I don't really fight it because I've been in this 30 years. I'll give you an example, Del. When COVID hit, I have a system where if I needed to call a meeting, it holds about 10,000 people, right? We had 20,000 people trying to get in. We couldn't accommodate half the people because everyone knew in COVID that knowledge was going to be their key. They just knew it. But by then, it was already in a landslide. It's too late to hedge. It's too late to beta weight. It's too late to use options. It's too late. And if you don't have that protection and you don't have those insurance policies in place, you might not have the money to reinvest at the low levels, right? You might not be making enough money in that crash to really take advantage of the new no level. So I would say that what people should do to prepare now is get educated. Every StockCast we do, there's StockCast bonus. And I let people spend a full day. I'll do full day trainings that I will stream from time to time, where if a person just took a day, at least they'd know what their opportunities are. At least they'd know a little bit how these options can help a person. Options are insurance. If a person wants insurance against the car crash, buy car insurance. If people want insurance against a market crash, learn to buy options insurance. And that's available there for the taking, that education. So the biggest thing to be afraid of is ignorance. It's not a market crash. Warren Buffett is looking forward to a crash. He's got almost $200 billion on the side ready to invest. He's waiting for it to happen with anticipation. When I see a crash, I get excited when I see a stock drop. If it's a good company, it's on sale. So it's not the crashes you'd be afraid of. It's the ignorance to be afraid of. And if a person doesn't know how to seize those opportunities or defend themselves, that's when the crash is scary. It's only the people who are in the know look forward to that stuff. And across all asset classes, everyone gets excited when they go on sale. All the investors do. The real investors do.
Well, the real investors like Warren Buffett, and you think about his daily schedule. What does he do most of the day? He educates himself. He reads. Yep. He educates himself. Can you share any final thoughts on the importance of staying educated? As you look at like Warren Buffett or yourself or anyone else that has made it big, what are they doing with their education?
Yeah, it's interesting because I've been doing this 30 years and I still feel like a student. I'm looking to learn constantly about new things. The world changes all the time. AI changes. Just investing, the principles remain unchanged. They're universal and they're true in all cases. But the education of applying those principles changes all the time. And so it's so funny because I'll talk with my wife and I'll say, if I'm nervous about not knowing enough, having been a student and a teacher for 30 years on this topic, if I'm worried about what I don't know yet, it just blows me away that the people that know almost nothing, how vulnerable they are. It's incredible. So I would, my mission aligns with the Rich Dad mission. We're improving well-being through financial education. That's what we're about. We want to elevate the well-being, the financial well-being of humanity, and that's done through financial education. So people are either going to do it or not. So there you go.
I love it. I love it. Well, that's a wrap for today's episode of Rich Dad StockCast. We hope you found our discussion on the labor market's impact on the economy and stock index levels insightful. And a big thank you to Andy Tanner for sharing his expertise with us. Andy, it's always a pleasure. Thank you for sharing your wisdom with us.
We'll see you next time, everyone.
Absolutely. Now, remember, Whether you're just starting out or you're trying to save or nearing retirement, the key is to stay informed and educated. And speaking of education, don't forget to visit stockcastbonus.com for free resources that can help you on your financial journey. If you've enjoyed today's episode, please make sure to like, subscribe, and leave us a comment. Your feedback helps us improve and bring you more of what you want to hear. Share this podcast with your friends and family to help them make better financial decisions too. Thanks for tuning into Rich Dad's StockCast. Until next time, stay smart, stay invested, and take control of your financial future. I'm Denney. We'll see you on the next episode.
Thanks, Del.
This podcast is a presentation of Rich Dad Media Network.